Let's talk about the importance of correlations. All a correlation means is when one market goes up, the other market will go down, or if one market goes up, the other market will go down. So one of the basic correlations that you need to be aware of when you're intraday trading futures is there's usually a decent correlation between the index futures and gold, and it's usually a negative correlation. In other words, if the index futures go down, gold goes up. So what I want to do is show you, and it does not work all the time, but it is very, very crucial that you keep a keen eye on it so that you know when it's working and when it's not working, and that way you can kind of trade around the correlation effect. So you can see here at 10:25, let's back up, here's 10:15. So it's a 5-minute chart. At 10:15, you can see, I'm going to use the ink, it just gets the point across a little bit better. Here we go, I'll grab some ink. So at 10:15, right here, that's 10:15, you can see that the S&P mini sold off a little bit. So it started to sell off and it went down and then it retraced up. So now what you do is you come over here on this other chart and you look for 10:15 on this chart, and you can see at 10:15 it went down and then it went up. So on today's correlation, it's not a perfect correlation, but you can see some divergences in the chart. So in other words, on the S&P continued to go lower and then stopped and then reversed and then took out their high. Now, notice what gold did. Gold sold off hard, took out their low, and never really retraced through their high. So that tells you that gold is a little bit weaker than the S&P. Even though the S&P is down 3 1/4 and gold's down $3.40, gold is a little weaker than the S&P. So in other words, if the S&P would rise in price, you would probably see gold go even lower. So remember, next time you're intraday trading, make sure that you are aware of the correlations that are working and of the correlations that are not working, and then you can trade around those.